After a period of strong equity market returns, it's very tempting to look back and think, if only I'd taken more risk, then I could have had even higher returns. But that's actually a misleading way of thinking, as we'll see in a moment. And in fact, it can actually destroy some wealth if you do have leverage in your portfolio. And I think you might be surprised by the degree of destruction that it may wreak with your wealth. So now let's look at leverage and leverage funds in a bit more detail. The definition of leverage is that you borrow money to invest. In other words, you're amplifying your returns, both positive and negative. So your gains are bigger and your losses are also bigger. And you can achieve this in various ways. You can buy options, you can buy futures contracts, or you can go for something called contracts for difference. Alternatively, you can buy a fund which has leverage built into it. So for example, this exchange-traded fund offered by WisdomTree gives you the 3 times daily return for the S&P 500. What that means is that if the S&P rises 1% over a day, then this fund will give you a 3% return. But if the S&P 500 falls by 1% over a day, then this exchange-traded product will fall by 3%. If you want to find a list of exchange-traded funds with built-in leverage, then you can find this list on Just ETF. And you can see they're not just about equity. So this one is an inflation ETF. This one is based on a steepening and flattening of the US yield curve. But these 3 funds at the bottom are levered equity funds. So this one gives you 2 times the daily return on the DAX index in Germany. This one 2 times the UK FTSE 100 index. And this one from Xtrackers gives you 2 times the S&P 500 daily return. Just ETF is for European funds. If instead you want to look for leveraged ETFs in the United States, then ETFDB is very good. And as usual, US investors have a much bigger choice. It's always interesting to see what Warren Buffett thinks about something, and he's not very keen on leverage. Or as he puts it, it's crazy to borrow money on securities because it's insane to risk what you have and need for something that you don't really need, which are the higher returns you might get if you go for a leveraged version of your investments. A good place to start is to clear up a misconception about what 3 times daily returns actually mean. Because 3 times daily returns does not mean 3 times the cumulative return of an index. Here I've got the return on that S&P 500 3 times daily return fund that we saw earlier from WisdomTree. And that's shown in green on this graph, whereas the blue line is 3 times the cumulative return on the S&P 500. Notice how the blue line is not the same as the green line. Sometimes they get pretty close, but it's not the same thing. And the difference between the two gets much greater when we have a big equity market fall, as happened in February and March 2020. What this ETF gives you is not 3 times the cumulative return of the S&P 500, which is unfortunate. What it actually gives you is something which falls much more. Now the red line which I've added to the graph shows you the S&P 500 if you just bought a simple tracker. Despite the sharp drop in markets at the beginning of 2020, you can see that the S&P was still up 5% over this 3-year period. But the 3 times daily levered fund ate away all of the 3-year gains and lost a lot more. So in total it was down 41%. So while these daily levered funds give great returns during bullish market periods when equity markets are rising strongly, when equity markets go into reverse, they can very rapidly lose a lot of their value. And what worries me at the moment is that these very strong rallies that we've seen form a kind of honey trap for leverage. Recent experience lulls people into thinking that stocks only go up. Now personally, I find these drawdown graphs very useful. What they show you is the percentage fall of an index or a fund relative to its previous all-time high. So when the value is 0, that means that the index or fund is setting a new all-time high. But then as soon as the line starts to drop, you can see that the fund has dropped from its all-time high and it's drawing down from that previous value. Now what really characterizes markets over the last year or so is that the size of the drawdowns is pretty small. The S&P hasn't fallen more than 5% from its previous all-time high even once. In fact, if we look at those drawdowns and see how long they lasted, the longest one was 71 days, and that was between September and November in 2020. That's this drawdown here. Investors have been conditioned to think that it's always good to buy the dip. In other words, when equity markets fall, then you buy more equity. Now, generally that is a really good practice, but what I think is worrying is that this has made people think, well, maybe I should go and get leveraged exposure to the equity market, because it never falls much. So let's try looking a bit further back in the past to see what pain you could have felt if you'd have gone for a leveraged ETF, say. So here's another one of those drawdown graphs which shows you the percentage fall relative to the previous all-time high. And what I've done is to mark the biggest drawdowns over that period of time. The longest data set I could find for a 3 times levered fund only went back 3 years. So what I've done here is I've taken the S&P 500 and just multiplied its returns by 3. And when we do that, you can see the huge drawdown which lasted almost 20 years between 2000 and 2019. Now, during the worst point of that drawdown period, you'd have lost 98% relative to the previous all-time high. Let's just consider that for a moment. Let's say your all-time high in 2000 had been $100,000. What this means is that by 2009, that would have fallen to just $2,000. With that kind of drawdown, I think it would be extremely difficult not to sell at some point during that fall. But as we know, it's almost impossible to time markets. You never know whether a 10% fall is going to get bigger and turn into a 40% fall. So if you sell at the first sign of trouble, you could well be locked out of the markets. So all of our cognitive biases which apply to normal equity funds just get multiplied up with these leveraged funds. And that wasn't the only period when leverage would have really hurt your wealth. There was a period between 1973 and 1983 when your 3 times levered fund would have lost almost 90%. And there was also a 5-year drawdown period after the 1987 flash crash. So what's pretty clear is that this recent period with very few drawdowns is fairly unusual. And if you do get lulled into taking too much leverage when equity returns are strong, you could get very, very badly burnt. So I think the problem with these leveraged funds is not one of returns, it's one of psychology. If we look at that 98% drawdown in 2009 again, what we never think is, oh, my fund is up almost 2,000% since 1962. What we always do is to fret that our fund is down 98% relative to its previous all-time high. And that's what makes us want to sell. It's kind of like putting your hand in a fire and then trying to withdraw from the pain. It's just our instinct to do that, even if it's not the optimal thing to do. If you'd have held on through these huge drawdown periods, you'd have actually ended up with a much better return with a levered fund than you would with an unlevered fund. If you enjoy our videos, then you'll love our newsletter. It's free and I send it out on a Friday evening. It's punchy, it's packed full of educational nuggets. And to learn more, just click on the link beside me and in the description below me. And again, there's a nice Warren Buffett story about this, which is about Rick Guerin, who worked with Warren Buffett and Charlie Munger in the early days of Berkshire Hathaway. Now, not many people talk about Rick Guerin because of what happened to him in the 1970s. As we saw, one of those drawdown periods was in the early 1970s, and when the stock market fell very sharply, almost 70%, he had to post margin. That meant he had to come up with cash to cover his losses. And the way he got that money was to sell his Berkshire Hathaway stock for about $40 a piece. The current share price of Berkshire Hathaway is over $400,000 a stock. So a more reliable way to be successful in markets is to just stay in the game for longer and to avoid leverage. So if 3 times levered equity falls a lot, then how about getting a diversified portfolio where we also lever up our bond exposure? So here's the value of $1 tracked since 2017 invested in that 3 times daily S&P tracker that we saw earlier. And as we saw, it fell very sharply at the beginning of 2020, but that wasn't such a big problem if you also had 3 times daily levered US Treasuries. That's the blue line. Because at the same time as the equity was falling, that levered treasury fund was rising very sharply. So by taking a 3 times levered bond fund and combining it with a 3 times levered equity fund, you can come up with a diversified 3 times levered portfolio. Now, you don't have to have a 60-40 combination of equity and bonds in that portfolio. We can actually vary the amount of equity from 0%, so this is 100% bonds that you can see beside me here, all the way up to 100% equity, Now the price you pay for that is that the volatility is very high. So for this 100% 3 times levered equity portfolio, the vol is almost 50%. Now typically for the S&P 500, the volatility would be around 16 to 20%. But if you are willing to take that risk and also suffer the very large drawdowns, you can see that the return is better for more equity. So the annualized return since 2017 for that portfolio, which is 100% levered equity, was over 30% per year, whereas the 100% leveraged bond fund only gave you below 5% annualized returns. But the benefits of diversifying are very clear when we look at the drawdown. So the top panel here is the drawdown of the pure equity 3 times portfolio. And there you can see in early 2020, you'd have lost about 3/4 of your capital relative to the previous peak. Whereas for the 60/40 3 times levered portfolio, you'd have only lost about 50%, which is comparable with what you'd have lost if you had a non-levered S&P 500 tracker. Now Michael Batnick, who writes the excellent Irrelevant Investor blog, came up with this analysis on his blog. And he showed that if you push the analysis back to 2005, the levered portfolio does very well indeed. So that had an annual compounded growth rate of 14%, compared to an unlevered portfolio, which is 60/40, which only had 8%. But what you can also see is that his rebalancing rule was that if the portfolio drifted 5% away from the 60/40 weights, he'd rebalance. And in total, that happened almost 100 times over this period. And Michael Batnick's conclusions were similar to mine, which is that it's probably not worth doing it. And that's because it requires so much work. You have to constantly monitor your portfolio, and you also have to be willing to weather those extremely large falls when equity does tumble. So while leverage can turbocharge your returns, those can also be wiped out if you fall prey to these cognitive biases. There's also a great free paper by Tal Miller, who contacted me on Twitter to tell me about it, called Leveraged ETF Investing. And what he does is to extend the period of analysis using Monte Carlo simulation. And what's interesting is he also considered the effect of tax on this approach, because if it does generate very high capital gains, that could incur very high taxes when it comes time to rebalance. He also compared returns when you have margin debt rather than one of these levered ETFs. Margin debt, you can see here in black, has higher returns he found than the levered ETFs, which you can see in red. And his conclusions were that clearly it increases your returns, but as long as you have that long-term mindset, it doesn't really increase your risk, as long as you're willing to look through that volatility. But he does concede that this has higher psychological risks. In other words, you're very tempted to sell when you see these very large drawdowns. So I think there is a case to be made for leverage in a portfolio, but probably not for the core of your portfolio and probably not all the time. But I think after an equity market crash, it's certainly something I'd consider as part of my crash shopping list. So remember, if you do want to support us, you can always subscribe to our channel and like this video. And as always, thank you for listening.